This is the 30-minute guide to investment success. I'm Richard Evans, ex-investment advisor and author of 3 books on how to invest. In the next 30 minutes, I will tell you all you need to know to invest successfully. In fact, more successfully than you can with most money managers. We're in a difficult time for investors. Stocks and bonds jumping around like kangaroos, and signals mixed about the future. Lots of people wonder if they should just sell out and wait for better times. I've studied conditions like this for decades, and what I can tell you is no. Investors should not sell their investments in hopes of coming back at a better time. You'll see why in a few minutes. Oh, and before we get rolling, I should tell you I play jazz piano, partly to take a break from my technical work. So I'll do some of that here. Now I can guess what you're thinking about a short talk on how to invest. Investing is a complex subject. Professors write books about it. How can Evans tell me anything useful in just 30 minutes? Fair question. The answer is that my approach is built on just 5 simple rules. Rule 1, invest only in index funds. Rule 2, invest in total market stock index funds. Rule 3, invest in total market bond index funds. Rule 4, invest globally, not just in the U.S. Rule 5, buy and hold. Don't tinker with your investments. And that's it. Those 5 rules summarize an approach to investing that's been successful for over 90 years. But the rules themselves are not enough. You need to know why these rules are so effective. Otherwise, you're not likely to act on them. So let's get to it. I said rule 1 is to invest only in index funds. Time for definitions. An index, for our purpose, is a list of companies with something in common, like size or type of industry. An index fund is a group of stocks or bonds of the companies in a given index. Stocks, by the way, give you a share of a company, while bonds are a loan to a company. One well-known index composed of big stocks is the Standard & Poor's 500, which has grown by an average of about 10% a year for over 90 years. Now, here's the thing about companies in an index fund. They're not selected by the judgment of investment experts. If a stock or bond meets the fund's criteria, it's in. If not, it's out. Simple as that. This approach contrasts with what's called active management, which happens when a money manager uses his or her judgment to decide which securities to own and when to buy and sell. These people are experts, so they must get better results than index funds, right? Wrong. Year after year, index funds outperform most of their actively managed counterparts. Example, in 2021, the S&P Composite 1500, a total market index, outperformed 90% of domestic stock funds. Yes, I said 90%. Wait a minute, you may be thinking. How is that possible? How could an unmanaged group of stocks do better than a group managed by brainy people trained in the art of investing? Well, it turns out there are several reasons. The most basic of which is that money managers can't predict the future. For example, how many money managers knew that Brexit would actually happen, or knew that a single online company would radically change retail marketing, or knew that Russia would not just menace Ukraine, but actually invade? Surprising things do happen, and because of that, money managers make mistakes about which stocks or bonds to select. With index funds, there can't be a selection mistake because you own all the stocks or bonds in the index. So that's one reason index funds tend to outperform actively managed funds. The second reason is costs. You can own the kind of index fund I suggest without paying a single cent in management fees. An actively managed fund is a different story. Here, people you hire choose the securities in a fund and decide when to buy and sell. For this, you pay a fee called an expense ratio, which on average runs to about 0.5% or more of your invested money. Doesn't sound like much, but what most people don't realize is that costs accumulate. The first year, yes, it's only 0.5% of the money you invested. But the second year, it's another 0.5%, not out of your original amount, but out of an amount diminished by the first year fee, which hurts in two ways. One, it enlarges the percentage bite of the fee, and two, it cuts the amount of money available to grow. And the longer you have the fund, the bigger the bite becomes. Over 20 years, those measly seeming fees can take a huge chunk out of your nest egg. A third reason index funds tend to beat actively managed funds or portfolios is the impact of Bloomberg terminals. Going back a few decades, money managers had different ways of getting the information they wanted. So it was possible for one money manager to have better information than his or her competitors. Today, everybody in the business has electronic terminals, so everybody has access to the same information at the same time. Result, it has become extremely hard for a money manager to beat the S&P 500 or any other total market index fund. Now I hear you thinking, okay, but all that doesn't matter because you're telling me that 20% of active managers did beat the S&P 500. So I'll just buy the winners and not the losers. No, you probably won't. Just because an actively managed fund beat its benchmark in the past does not mean it will do so in the future. My latest book, The Smartest Way to Invest, has an example. A Dow Jones company studied the progress of nearly 3,000 actively managed mutual funds that had one big thing in common. They were all in the top performing quarter of a huge group of stock funds. After 5 years, guess how many of the nearly 3,000 funds were still in the top quarter? Are you ready? The answer is 2. Only 2 funds out of roughly 3,000 did well enough to stay in the top group. Still, a person could think, not a problem. I'll just buy those 2 and I'm sure to beat the market. Again, I have to say, no, you won't. Dow Jones looked at the same group of funds 1 year later. Know what they found? None of the funds did better than the total market. None out of 3,000. All right, you may say, but at least 2 funds beat the market for 5 years. So it's possible, despite everything you've said. Possible? Yes, but irrelevant, because there's no way you or anyone else could have reliably identified those 2 funds up front. Now, if all that sounds too complicated, remember this single fact. Over time, index funds tend to outperform at least 2/3 of actively managed funds of the same type. Okay, we come to the second rule. Buy total market stock index funds. That means funds with a representative sample of all the investable stocks in the U.S. or globally. Here I include S&P 500 index funds, which are generally considered total market funds. This emphasis on total markets may seem strange. There are lots of different kinds of index funds out there. Why not look those over and pick a few that seem like they'll grow faster than the market as a whole? Here's the answer. Whenever you buy anything less than a total market, you are making a prediction, whether you realize it or not. Buy any group of mutual funds or other kinds of assets, and you are predicting those assets will outperform the total market. Otherwise, why do it? The point is that the total market is the standard, the default investment. When you look at other ways to invest, it's not enough to ask if they will produce a good return. A more useful question is, will they beat the total market? Okay, we're at the third rule, which is to buy bond index funds. Historically, investment-grade bonds have returned only about half as much as stocks. So why own them? Well, the sun doesn't always shine. There are times when stocks just keep going down, week after week, month after month, and rarely year after year. At those times, you'll be glad you own a type of investment that tends to be a lot less volatile. If you're young, the bond portion of your portfolio should be low, so you can get more of the higher return of stocks. As you age, it's usually a good idea to increase the amount you have in bond funds. The amount depends eventually on your risk tolerance and personal circumstances. But when you buy bonds, follow the same rules you use for stocks. Buy bond index funds and buy total market funds. Why? Because you don't know which parts of the bond market will outperform the total market. In fact, nobody knows. There is, however, one exception to the total market rule in bonds. If you're a high earner, it may be better to concentrate on municipal bonds, which pay less than other types of bonds, but are typically free of federal taxes. You have to do the arithmetic to see which kinds of bonds may give you the higher after-tax return. The fourth rule is to own a global portfolio. By now, you probably know why. Nobody can predict the future, so you want to own securities that may be going up while U.S. stocks are going down. Foreign stocks have the potential to do that. In fact, foreign stocks have often outperformed U.S. markets. As in the U.S., resist the temptation to try to guess which foreign stocks will grow faster than the total. Instead, buy total market international stock and bond funds. The same principles apply as in the U.S. The fifth and final rule is buy and hold. Don't tinker with your investments. This is the big one. The one rule that may have the highest impact on your investment results. Why? Because decades of history show that what the investor does is often more important than what the markets do. Let's look at a couple of examples shown in my book, The Smartest Way to Invest. During the 30 years ended in December 2013, the S&P 500 grew at an annualized compound average rate of 11%. A good rate. But what did the average mutual fund investor earn? After costs, a pitiful 3.7%. Why? Because investors sold when the markets fizzled and bought when they boiled. The same idea applies to bonds. Over the 20-year period ended December 2015, a Barclays Total Bond Market Index grew at a compound average rate of 0.55% per year. The average bond investor earned, are you ready? Minus 3.1%. This is the kind of thing that happens when investors fail to buy and hold. It's human nature to want to sell when the markets drop. It's also human nature to believe you'll know when to buy back in. The truth is, you won't. Study after study proves that nobody can time the markets. Talking about buy and hold brings up the subject of rebalancing. This is the process of adjusting your portfolio from time to time to maintain your desired balance between stock index funds and bond index funds. It works like this. You set a balance that suits your circumstances. Say it's 75% stocks and 25% bonds. When a drooping stock market changes your balance by more than 5 percentage points, say down to 68%, you fatten your stock funds by just enough to restore the balance you want. If your stock funds move up by more than 5 percentage points, you do the opposite. Slim down your stock funds and build your bond funds. That way, you keep buying low and selling high, which is a great way to make money. This does not break the rule of buy and hold. You're not selling or buying to time the markets. You're doing it to keep a proper balance between stocks and bonds, no matter what the markets do. Also under the heading of buy and hold, it's good to keep a 4 to 6 month supply of cash in a bank or money market. You don't want to be forced to sell securities if you suddenly need a lot of money. And finally, you may have heard of ETFs, or exchange-traded funds. These are funds you can buy and sell anytime the markets are open. Sounds good. But because they're so easy to buy and sell, they encourage people to try to time the markets, which, as we've seen, is a bad idea. So now you've heard the 5 rules that will help you invest successfully, bearing in mind that all investing involves the risk of loss. The 5 rules again: buy index funds, buy total market stock index funds, buy total market bond index funds, buy globally, buy and hold. If you follow these rules, you're likely to own a simple portfolio with only 4 mutual funds, all of them index funds. 1. Total U.S. stock market. 2. Total international stock market. 3. Total U.S. bond market. 4. Total international bond market. You can shop for total market index funds at several companies, including BlackRock, Fidelity, Schwab, and Vanguard. And you can learn more about what we've covered here from any of my 3 books, which show the hard evidence behind what I've said. For my latest book, go to Amazon and type in The Smartest Way to Invest. And if you'd like a free copy of this talk, write to me at index.info@me.com. Again, for a free copy, email index.info@me.com. Thanks for listening.